All right. Today is Wednesday, July 7th. This is a recap for the stock market activities today. The story remains the mystery in the bonds market. What message is the bonds market trying to send? Because yields continue to drop in a significant way. Now, we know that yields, specifically the long end treasury yields, are indicators for inflation. They go higher as inflation expectations rise higher, and vice versa. But they also act as indicators of economic growth. If there is more optimism in the future regarding economic growth, we see yields climbing higher. But if yields go down, it is a sign of pessimism on the future of economic growth. Yesterday, we explored three possible reasons to explain the action in the bonds market. Number one, is it a reaction due to Delta? We know that the Delta variant is causing a lot of problems in many countries. For example, in South America, we have Colombia, Argentina, Brazil still suffering from COVID-19. And cases continue to rise higher due to the Delta variant. Likewise, we have cases rising in Russia, Indonesia, the United Kingdom, and a lot of other countries. Some countries are imposing lockdowns once again, and we have a lot of questions being raised regarding the efficacy of the current vaccines versus the Delta variant and perhaps other variants that are about to come. So is the bond market looking into the future and seeing a problem here of a re-emergence in a big way of the COVID-19 crisis? Still skeptical because the evidence we have so far is that the current vaccinations remain effective. Matter of fact, the death rate globally remains at the lows, even though cases are rising in many other countries. And we're seeing more evidence that the severity of cases are happening with unvaccinated people versus vaccinated. So I don't see a problem here, at least in the near future, regarding Delta. We explored another reason to explain the action in the bonds market. Could it be that inflation is rising too high to the point where it is acting as a force of stagflation in the economy? And this is the signal that the bond market is trying to send. Doubtful, because under stagflation, rates should rise higher, not go down. The last explanation we looked at last night was the technicals. And this is what I'm leaning toward for now, because it is the most reasonable argument for now. Now, there are more arguments, there are more theories. For example, the reverse repo operation is distorting the price action across commodities, the bond, and stock markets. Could be, as the Fed attempts to take some liquidity out of the system. But once again, the reverse repo itself is not going to be enough to suck the liquidity out of the system. We have excess liquidity, and at some point, the Fed has to face the music and do the tapering to get rid of the excess liquidity in the system. Now, here's the problem. If the market is just following the technicals, and therefore bond yields are dropping down significantly, then we should see an algorithmic reaction in the stock market. When yields drop significantly, we expect technology, growth stocks, in addition to the high multiple stocks, to appreciate and catch a bid from market participants. Here's the heat map from today's activities. We're not seeing this at all. We're not seeing the growth stocks, the high multiple stocks, appreciating even though yields dropped significantly today, violating the 1.35% threshold. And what's working instead is the defensive theme of big cap technology names, whether we're talking about Apple, Amazon, Microsoft, in addition to safe, dividend-paying stocks. Those are found in the industrial, healthcare, and defensive sectors of the market. And while we're at it, let's do the heat map analysis for today. Yields are down. Tesla's not performing. The high multiple names, the growth names, Airbnb, Snap, Pinterest, Uber, Palantir, they're all getting whacked today. Solar names, biotech, they're all getting slammed heavily. Likewise, we're seeing a lot of pain in the reopening trade, whether it is cruises, hotels, casinos, airlines. And the question is the market reverting back to the defensive theme due to fears of Delta, for example? Is this the explanation behind the pain we're seeing in the reopening trade, or is this just mere profit taking from a very profitable trade? The reopening trade, it has been working since last year. Perhaps this is the time where market participants are taking profits from these names. For me, this is the plausible explanation for now, because while we're seeing a defensive theme in the market, we're not seeing a solid rotation back to the stay-at-home stocks. We saw Zoom, for example, outperforming yesterday, but today not so much, is actually underperforming. So I remain skeptical that this action we're seeing right now in the market is due to Delta fears. What I see is uncertainty. The market dips its toes back and forth. Should we buy the dip in the inflationary trade or not? You see industrials outperforming one day and then underperforming the next. So the market is confused. It is tilting into going back in the inflationary trade of industrials, metals, energy, and financials. Now, we have a problem with financials because yields continue to collapse. We have a problem with energy due to the OPEC disagreement, and it is pushing oil prices down, at least for now. We're seeing profit taking in the oil trade. So the revival of the inflationary trade will happen via industrials and materials, in my opinion. But until the market is confident to do so, we will remain in this confusion state. Let's explore the other side. Technology, what's going on here? We talked about the so-called defensive theme. When you look at the map, you see Apple outperforming day after day after day. And you think, okay, this is a defensive theme because semiconductor names are not performing. High growth names are not performing. The reinflation cyclical trade not performing. But somehow Apple, Amazon, Microsoft, the big cap technology names are. So right away, the assumption is we have a defensive theme. But the devil is always in the details, by the way. The move, at least in Apple, is being driven by the options market, meaning that market participants are not drifting back to the defensive theme and legitimately buying Apple, Microsoft, and Amazon. They're actually buying call options on Apple. We saw the volume exploding higher. So be careful of assuming a reversion to the defensive theme of big cap technology names by looking at the performance of Apple the last few weeks. Things are being distorted due to the action in the options market. In addition, once this whole Jedi contract came out to light, we're seeing speculation in the options market on which company will take over the contract. And therefore, you're seeing names like Oracle blasting higher. And now we have SAP and Snowflake also catching a bid via the options market. This is speculation. They're buying call options to do a trade, not an investment, not adding these positions to their portfolios, not rotating anywhere. Of course, we know the Pentagon is not going to pick a German company, SAP, for the Jedi contract. Likewise, it's not going to pick Snowflake. The likelihood is it's a toss-up between Amazon and Oracle. And we know, for those of us who were not born yesterday, this is corruption. Giving the contract to Microsoft to begin with was due to corruption. And now we have more corruption to undo the contract and give it back to where? To who? Amazon. So once again, looking at the map, if you combine it with the options market, you realize that this so-called defensive theme of big cap technology names isn't really there. They're just speculating and buying call options on Apple, Amazon, and the likes. Likewise, the inflationary trade, we have hesitation here. The revival of the inflationary trade will happen by either industrials or materials. But until the market is confident to do so, what do we do here? As market participants, where do you park the cash? In this state of confusion and distortion, how about the actual safest sector of the market? Healthcare. You look at drug manufacturers, the big ones, in addition to health insurers, and you see cheap valuations, excellent dividends, and relatively low volatility. The healthcare sector is not involved one way or the other between this rotation back and forth between the inflationary and disinflationary theme. And that makes healthcare, for now, in this state of confusion, the best place to park cash in. Beside that, we did not have any major news today. We had jobs openings and they continue to climb higher, and this continues to fuel wage inflation higher. Likewise, we had the FOMC minutes. There was nothing new there. We knew that publicly the Fed will say that they will remain accommodative and they will let us know in advance when the tapering will happen. But when you read the minutes, we know that privately they're beginning to become more concerned about inflation. But there is nothing new there. The facts remain the same. The Fed has not changed the policy yet. Inflation continues to rise higher, and we still have the fiscal spending tsunami, starting with infrastructure. So the facts remain the same. Anybody who goes on and says, hey, the action in the bonds market is an indicator of deflation, or that inflation is transitory, they will be proven wrong because the facts haven't changed yet. For now, it is anybody's guess why the bonds market is reacting this way. Anyhow, we have a lot of technical developments in many stocks and many markets. So we'll go over that, but first, let's cover the market's performance today. And here we go. The Dow Industrial Average closing in the green by 104.42 points, or a gain of 0.30%. The Nasdaq closing slightly in the green by 1.42 points, or a gain of 0.01%. The S&P 500 closing in the green by 14.59 points, or a gain of 0.34%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, basic materials. At number 2 for the silver, industrials. And at number 3 for the bronze, utilities. Meanwhile, the laggards of the day led by energy, communication services, and cyclicals. Now, all in all, it was an inflationary theme because you're seeing metals and industrials outperforming. On the other hand, we have an underperformance from other inflationary sectors of the market, namely energy and financials. Financials are not performing because yields are down. Energy not performing because crude oil prices are going down due to the dispute in OPEC. What about the market breadth? Here it is, the advanced decline ratio. NYSE 44% advancing versus 53% declining. The Nasdaq, pay attention here, 28% advancing versus 69% declining. While the Nasdaq closed in the green and we continue to see sizable gains in Apple, Amazon, Microsoft, etc., the breadth under the hood of the Nasdaq remains awful, and this has been the story for weeks now. We see the Nasdaq closing in the green, climbing higher with bad advanced decline ratio, indicating that the rally in the Nasdaq is extremely fragile. Moving on to futures, what's going on here? We're seeing a pullback in crude, whether it is the WTI or Brent going down, just a small drop, not a big one. We still have the facts intact. There is no production increase all the way to April 2022. Regardless of the dispute between the Saudis and the UAE. The problem is that the dispute caught the attention of the Biden administration and traders who left the trade on autopilot, expecting crude prices to reach 80, 85, even 100 before considering taking profits. This dispute caught the attention of traders, and now they're reflecting and saying, you know what? Perhaps it is not a bad time to take some profits off the table. The Biden administration under a lot of heat because gasoline prices continue to climb higher to historical levels, and traders are looking at the possibilities. The Biden administration will likely meet with the Saudis very soon. The topic of oil prices will be brought up. Traders are looking at the situation, assessing the facts, and saying, you know what, it is not a bad time to take profits off the table. Now, here is an OPEC output breakdown. And as you can see, the UAE, a very rich country with crude oil, they want to increase the output because for now, they're stuck at 10%, slightly above Iran, which is under sanctions. So the UAE want to increase their share of this breakdown, perhaps to be equivalent to, say, Iraq. And when you have an agreement in place all the way to April 2022 that nobody will increase the output, the increase of the share that the UAE is looking for has to come as an expense for other producers. Is it going to be a share out of Saudi Arabia's, Iraq, other producers? Of course not. They don't want to decrease their own share, and therefore you're seeing this whole battle and disagreement between OPEC members. On surface, this should be good for oil prices to rise higher because nothing has changed so far. So for now, we're seeing some profit taking, but my call is oil prices will continue to stay elevated. What about softs? We're seeing modest declines here for lumber and sugar. And by the way, we have news regarding sugar. Perhaps this will be a bullish catalyst for sugar futures to rise higher. Sugar refineries waiting for sky-high shipping rates to ease before locking in purchases may find that supplies tighten by year end because the volume of sugar awaiting to be exported at Brazilian ports is a lot lower than prior years, which means we're about to see a sugar shortage and this will push sugar prices higher. For now, sugar producers in Brazil are not producing more because they already have product waiting at the port with no takers. The moment sugar refineries realize that shipping rates are not going to get any better, perhaps slightly lower than they are right now, but for the foreseeable future, this is a country, Brazil that is still getting hit hard by the COVID-19 crisis. At some point, the refineries will give up and they will start buying the product awaiting to be exported at the ports. They will incur higher costs, and those higher costs will be passed down all the way to the end customer. And when the product awaiting at the ports to be exported is already purchased, now we have a shortage in sugar. Farmers have to produce more. We have a drought. We don't have the output. The volume is already down year over year. It is below the 5 years average. Therefore, the supply to demand dynamic for sugar will support higher prices. Back to softs futures. We saw gains, slight ones for cocoa and cotton, but sizable gains for OJ and coffee futures. And I got news for coffee, by the way. Here it is. Also out of Brazil. Your cup of coffee may start getting pricier. Here we go. Coffee bean prices on international markets have surged as crops in Brazil have been damaged by a terrible drought, leading to the first supply shortfall in the coffee market in 4 years. So we're expecting sugar and coffee prices to rise higher. Rest in peace, lattes. What about metals? While the US dollar continues to climb higher, we're expecting a top any moment here in the US dollar. And perhaps metals futures are seeing the same thing. Perhaps the US dollar is rising higher due to expectations of tapering and the reverse repo operation. But it appears as if metals futures already made up their minds that the US dollar is topping, and perhaps this is the time to ignite a new fresh rally in metals. We saw modest gains for gold, silver, and platinum futures. Meanwhile, sizable gains for Dr. Copper and palladium futures. And by the way, palladium futures recovered the entire drop from the aftermath of the Fed's decision, or lack thereof. Tell me again that inflation is over. What about meats? We have declines across the board. Live cattle, feeder cattle, lean hogs futures all trading down today. What about grains? We have mixed picture. But here's my call. Remember, I have been bullish on corn since November of last year. I have been buying corn and I have been advocating for corn prices to go higher. I think the corn trade is over now, yet the momentum might continue for soybeans instead. So I will be shifting from corn to soybeans, whether it is actual soybeans or perhaps soybean oil. I like soybean oil at this point a lot better than soybeans. And the reason is China is planting more corn than ever before. They realize that they have a corn shortage and they're paying an arm and a leg to export corn from the United States. In addition, this is becoming a national security issue for China. Farmers in China are planting more corn this year with a potential impact on import demand. What are they talking about? Here it is. U.S. corn exports to China exploded higher since October of last year, and this was the premise and the catalyst for corn prices to explode impulsively higher. We talked about this exact dynamic back then in my thesis of buying corn. The export volume to China jumped from 131,000 metric tons in the year of 2020 to about 14 million metric tons in 2021. And now you know why corn prices exploded higher. If China is about to plant more corn, we know that the demand is still here, but now we're about to see more supply in the market. Whatever shortages we have here in the United States regarding our corn output will be replaced by Chinese output instead. But when Chinese farmers are ordered to plant more corn, and this is the right word, by the way, ordered, because this is state planning. This will come at the expense of other crops, namely soybeans. We have a declining output of soybeans from the United States, Brazil, and now China, because they will plant less soybeans and plant corn instead. So we have a catalyst for soybeans to continue to rally higher. There you go. Sugar, coffee, soybeans. Perhaps this is the new trade, replacing lumber, copper, and corn. Moving on to the big casino, the options market. And here it is. Apple at number 1 with massive options volume, the hottest table by far. When we talk about, Apple is catching a bid because we're seeing money flowing back to the NASDAQ and it is defensive. Garbage. Apple is moving due to the options market activities. Stop reading too much into things. 3 million contracts traded today alone for Apple. About 81% of those were calls. They're not buying the stock. There is no rotation to Apple and big cap technology stocks. There is no response to yields dropping down, sparking a legitimate rotation back to technology and growth. It's done via the algos and via the options market. That's about it. I haven't heard from any money manager saying, hey, we're rotating back to tech or growth. I haven't heard that yet, at least from the people I respect. AMC at number 2 with about 770,000 contracts. About 55% of those were calls. This is starting to unfold in a very bad way. The apes are all in, they're running out of ammo, and the shorts are about to slaughter them. We're about to see the massacre very soon. AMC down about 10% today. There is a lot of technical damage. They cannot support it via the options market. And we're seeing every ingredient of the recipe of disaster starting to be put together. At number 3, hello, AT&T. With about 660,000 contracts, about 59% of those were calls. Now, every time we see this name, spiking in options volume, trading with over 90% calls, it is usually a sign that the stock is about to be sold off. It's a contrarian indicator. Moving on to unusual trades, starting with the ticker EWZ. This is for the Brazilian ETF. Now, the Brazilian economy had every single catalyst to exploit the so-called super cycle in commodities. This is a country that produces oil, soybeans, corn, coffee, OJ, metals, produces everything, but somehow it missed the rally, the super cycle in commodities. And the reason is the country is in a mess of a situation. You have a political mess, you have the COVID-19 crisis still ravaging the country of Brazil. We're seeing death and cases continue to linger higher. Where is the light at the end of the tunnel for this country, for this economy? Perhaps somebody's seeing it because we have a bullish bid here. They're buying the 41 calls, expiration date July 30th, with expectations that the Brazilian ETF will rise by over 6% by then. They paid about 35 cents a piece to enter this trade. All in all, bringing the total to about $2 million. What about the trade for the ticker WISH, W-I-S-H? This is one of those meme stocks, context logic, whatever it is. And they're making a bullish bid here. We're seeing those meme stocks getting hit hard as of late. Perhaps the mania is frizzling out, but somebody's bidding for some gains in this name by buying the 11.5 calls, expiration date August 13th, with expectations that the name will rise by over 5% by then, and they paid about $1.60 a piece to enter this trade. All in all, bringing the total to about $1.6 million. What about the trade for the ticker LI, Li Auto? I've been talking about Chinese stocks. Avoid them. Don't invest in them. They're trades. They're not investments. When Alibaba dipped, I said don't buy the dip. It's a trap. Some of you listened, but most of you did not. Because I keep getting questions. What about Alibaba? What about NIO? Trade them, don't own them. And the reason is you cannot trust anything regarding the future, the economic future in China. Because China is cracking down against their own companies. They're realizing that if they let these companies grow too large, they're going to have a million Jack Ma. And this is how the beginning of the end of the Communist Party will happen. We're going to see these billionaires, rich Chinese, perhaps educated in the West, with a lot of influence, with a lot of respect from the population. And if they don't align with the Communist Party, then the Communist Party has a problem. And now they're cracking down across the board. And you're seeing Chinese stocks getting hammered. Li Auto is one of them. And somebody's betting for more pain to come. They're buying the 28 puts, expiration date July 30th, with expectations that the name will drop by over 12.5% by then. And they paid about 70 cents a piece to enter this trade. All in all, bringing the total to about $500,000. What about the trade for the ticker BEKE? This is yet another Chinese company getting whacked today, and somebody's betting for more pain to come. They're buying the 35 puts, expiration date August 20, with expectations that the name will drop by more than 10% by then. And they paid about $2 a piece to enter this trade. All in all, bringing the total to about $1.4 million. And here it is. What about the trade against the Qs, the Nasdaq? They're buying the 321 puts, expiration date August 20th, with expectations that the Qs will drop by over 11% by then. They paid about $1.65 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker CLDX? This is for Celldex Therapeutics. The name got absolutely hammered today, down over 7%. And somebody's betting for more pain to come. They're buying the 27 puts, expiration date July 16th, with expectations that the name will drop by over 7% by then. And they paid about $3.50 a piece to enter this trade. All in all, bringing the total to about $2 million. Lastly, what about the trade for the ticker AMC for A-Plan? Not good, folks. Not good. This is going to crash really bad. And somebody's betting on it. I'm not going to say who, but somebody. They're buying the 35 puts, expiration date August 6th, with expectations that AMC will crash by over 22% by then. They paid about $4 a piece to enter this trade. All in all, spending about $2 million for this trade alone. We're done with the heat map. We discussed that during the intro of this video. So we're moving on right away to the charts analysis, starting with SPY 30 minutes chart. We talked about 434 as the level of resistance. Well, the SPY battled this level back and forth for a little while and managed to close above that level, turning it into support. For now, this looks bullish. It looks as if the SPY is not finished going higher. We need a signal for a reversal before the SPY starts to go down. And remember, so long as we have this rotation back and forth, say the technology sector goes down tomorrow, but we see industrials and materials going higher, the SPY will hold. Here is a daily chart for the continuous contract for the S&P 500. Again, we don't have any reversal signal in this chart, none at all. The volume continues to pick higher, reversing the negative divergence, and the volume is picking up steam as the SPY trades higher. For now, this is bullish, and we have the momentum indicators remain positive, remain extremely strong. Yes, overextended, but that doesn't tell us anything at all regarding any upcoming reversal until and unless we get a signal. What signal are we talking about? How about we visit the Nasdaq 30 minutes chart? We have a gap and crap still holding above the resistance level we identified yesterday, 360.5, but we have a bear flag formation. Any technical analyst looks at the bear flag formation as bearish. And this is the expectations, by the way, that the Nasdaq is topping and we will see a reversal. Whether it's going to happen tomorrow as the bear flag plays out, who knows? But we're getting extremely frothy here. And I made the thumbnail for this video showing you previous tops in the Nasdaq. And the tops were in the form of a bear flag. Every single one of these instances, the Nasdaq topped with a bear flag formation. Here is a daily chart for the Nasdaq continuous contract. Are we seeing any reversal signal from the daily chart? Of course not. For now, the volume is starting to pick up higher. And we know that once the volume picks up higher, it will come to the downside for the Nasdaq. The RSI, the MACD, the momentum indicators remain strong, elevated, but still strong. We don't have any reversal signal from the momentum indicators. But when you look under the hood, the 30 minutes chart of the Qs, you start to see the weakness. You start to see the warning signals. When you look at the advance to decline ratio for the Nasdaq, it is absolutely terrible. When you have about 20% of the entire volume of the Nasdaq advancing, while about 80% declining, yet the index goes higher, that tells you that this rally is extremely fragile. It is led by Apple, Amazon, the big cap names. That's about it. If these start to reverse, the Nasdaq will go down. Now remember, what is the factor pushing Apple and Amazon stocks higher? Is it due to a legitimate rotation from money managers to buy these names? Of course not. It is happening due to the options market. And once these trades are done and profits are made and taken from these options trade, the rally will come to an abrupt ending. Moving on to small caps, the IWM 30 minutes chart. Yesterday, we talked about the bear flag formation, the failure to keep 229. We saw a mini bounce by the end of the day, but I told you this is short covering, and there is more pain to come for the IWM. Now the chart went down all the way, recaptured the support of 223, and also closed the gap, as I'm indicating in the chart. The chart has accomplished everything I asked for yesterday, closing the gap, confirming 223 for support, and we have a higher high here. So the question is, did I buy calls in the IWM? Not really. But if I had to bet, I would have bet for a rebound in the IWM. The only reason I didn't put my money where my mouth is the fact that meme stocks, chiefly AMC, is starting to look extremely weak here. And if AMC goes down, it takes down all of these meme stocks with it, and we will see more pain in the IWM. And this is the danger, by the way, of including all of these meme stocks in the Russell, whether it is the 2000 or the 1000. We have GameStop in the Russell 1000. Luckily, GameStop doesn't hold any significant weighting in the Russell 1000 because it includes Apple and giant names. Yet when it comes to the Russell 2000, the weighting of AMC is extremely large. And other meme stocks, when you combine them all together, they have an extremely large weighting in the IWM. So this was the source of hesitation for me not initiating the call options trade. What about the Dixie, the dollar index? Here it is. It continues to ride higher after catching the support of 92. Now we have resistance at 93. It is getting toppy here for the dollar index. The momentum indicators are becoming extremely elevated, extremely stretched. Metals are rallying regardless of the Dixie's rally. These are all indicators that we're getting extremely close to a top in this rally for the US dollar. The problem is we have the reverse repo. The Fed is trying to take cash out of the system, reducing the excess liquidity, but that's not going to work. At some point, as I said during the intro of this video, they're going to have to face the music and taper. Until then, I see the US dollar topping very soon. What about gold? What's going on here? Again, the momentum indicators are strengthening for gold. Gold managed to keep the Fibonacci retracement level as support. The expectations are that this leg higher in gold should take us at least to 1830, 1840, and then gold faces resistance. And here it is, yields. What's going on here? Massive flush down. Forget about any saucer bottoming here. It is a massive divergence from the descending line, which is an indicator that we are seeing a flush down scenario, and that will be a bottoming process. But how low can yields go? We have to go all the way back to the daily chart, and this is a little messy here, but we saw a massive reaction at 1.28%. Not once, but we saw a reaction at this level multiple times before from an intraday perspective, which makes it extremely important to keep. The 10-year yield has to keep 1.28. Otherwise, we get a bigger problem here. What message is the bond market trying to send? Because at this point, we don't even need to break 1.28%. At this point, the bond market is acting as if we're heading toward a disaster, a massive shutdown, a massive slowdown in economics activities. We're not seeing this yet, at least from the data we have right now. We're not even seeing it in any projections. When you look at all the numbers, they're still hot, even though they're off the lows. They're still hot. They indicate higher inflation. The economy just created 850,000 jobs in a single month. Wage inflation continues to climb higher across the board in every single sector of the economy. The Fed is still pumping the economy with unneeded liquidity. The fiscal spending hasn't even started yet. So what message is the bond market trying to send? This is the mystery prompting everybody to scramble, trying to decode the message from the bonds market. What about the TLT, bond prices? This is a weekly picture, by the way. The momentum indicators are strengthening, and there is plenty of room to go from a weekly perspective. The daily charts are getting toppy. The daily chart of the TLT is getting overextended, overbought, whatever terminology you want to use regarding the momentum indicators. So could it be that we hit 149, 150 and stop right there and we see a bounce back in yield? TLT goes down. From a weekly momentum indicators perspective, the rally is not over in the TLT, but perhaps it is ready for a break from a daily chart perspective. What about the VIX 4 hours chart? We've been tracking this chart for a while now. The MACD indicator is still trading in the green, and the VIX had a pop of about 20%. There is still plenty of room for the VIX to go higher. For now, it is holding ground. We have a gap. The VIX could go down all the way, closing the gap, and then bouncing higher again. But the last two pops in the MACD indicators are still weak. The first one resulted in about 13% pop, and this one we're in right now resulted in about 20% pop. We're looking for the big one. We're looking for a massive surge in momentum in the VIX. For now, it's unforeseeable because the SPY hasn't signaled any reversal signal yet. The SPY is still in this yo-yo game, rotating back and forth from tech to inflationary to reopening to stay at home, and the SPY continues to hold ground and climb slowly but surely higher. What about Apple, the most important stock to watch right now? We talked about 140 as support. This is holding for now. Apple gapping higher. Again, this is due to the options activities. Every time you see low volume in any stock or any index, but you see the series of gapping higher, understand that this is done via the options market. We saw this back last year, August 2020. SoftBank was behind it. Who knows who's behind this one? Regardless, the only resistance level we have right now to expect any reversal in Apple is the all-time highs of about 145. Now the trade is getting extremely crowded. We saw over 3 million contracts traded today alone for Apple. The majority of those were calls. Those traders who got in the trade early will start closing their positions as soon as we get closer to all-time highs, as soon as we get closer to expiration Friday, as the gamma squeeze starts to slow down. What about Tesla, the souffle? Ouch, what's going on here? We talked about 657. This is the gap. We don't have any reversal signal until and unless the gap fails to hold. And this is exactly what we got today. The souffle failed to keep 657 as support. In addition, the momentum indicators, the MACD and the RSI, are starting to curl down, indicating a loss of momentum in Tesla. When we zoom in, the 30 minutes chart, for example, yesterday we had a bear flag formation, but it wasn't good enough to initiate a short trade. And the reason is Tesla managed to close above the number slightly. It was bearish, but if you are conservative and you're watching for a confirmation before initiating any short trade, you got that confirmation today. We have another bear flag, and Tesla failed to keep 657 as support. Now it is trading well below the very important number of 679. So I initiated a put options trade against Tesla, and beside the technicals, we have major concerns regarding China. China is cracking down. The guy is going bananas, talking about blood and steel and smashing heads. And now he's cracking down against Didi, Alibaba, Tencent. Who knows what's going to happen here? But there is a massive surge in this nationalist attitude from the CCP. Are they going to start to hit Tesla next? Are they going to hit their companies and leave American companies like Apple and Tesla roaming around China, making all of this money, grabbing market share from Chinese manufacturers? Of course not. It is just a matter of time before China slaughters Tesla. When you combine the technicals and the fundamentals, we get a problem with the souffle. What about BTC, tulips? What's going on here? Laser beams, I'm still in your side. I am still watching 35,750. My expectations are that the tulip will be able to break above that level. But if you can't do it sooner than later, if the laser beams are too weak, they're just loud on Twitter and social media, but they don't have any cash to buy this dip because they're all in. You hear that, apes? Then we get a problem, because here it is. When you look at the formation, it is a bear flag formation. We got bear flags all over the place. This consolidation, if it doesn't break higher, and we're talking about soon, it got to happen this week. You got 2 days left and the weekend. I'll give you that. But if BTC fails to do so, to break above 35,750, impulsively so, then the bear flag will play out, 30,000 will not hold, and hello, 20,000 BTC. Lastly, what about AMC, the apes? What's going on here? Not looking good, folks. The support of 52 was violated. We saw the gap being filled at around 50 and then a bounce higher, and I gave the apes the benefit of the doubt. And then we got good news that the management is not going to dump on their heads. Why hasn't the stock climbed higher? This is a signal of weakness, extreme weakness. And now the stock is actually trading down in another, here we go, bear flag formation. I think I've seen enough here, and I have a conclusion. The apes are all in. They have no more ammo. They're waiting for the shorties to cover. The shorties are not going to cover. Whoever needed to cover already covered, and now we have about 15 to 17% of the float shorted. That's not going to be enough to take you to 100,000 per share. All these stupid cartoonish predictions that you people have been floating. You're going to realize that this is just another pump and dump. AMC will benefit because they raised billions of dollars. The management dumped a lot of stock. And at the end of the day, if there is no new blood to push this stock higher, it's going to frizzle out. People will give up. More shorts will pile in. And we will see the dump part of the pump and dump. I got one more chart for you before the conclusion. And this is for ARKK, for Tesla Witch Cathie Wood. Last time I showed you the chart, we talked about the oversold conditions, that this is an opportunity to buy call options for RKK. Well, now it's becoming overbought. We're seeing the momentum indicators turning the other way to the southern destination, and it is topping right about at the Fibonacci retracement level of 130. And this is a good point to close this video. If the bond market is sending a deflation message by dropping yields significantly lower, then this stock, RKK, is the poster boy for high multiple names, growth stocks, and the deflation theme. Why isn't this stock rallying impulsively higher as yields collapse? We got a problem here, folks. There is distortion because the algos would have followed the playbook. Yields down, buy RKK. It is not happening. And that tells you we have a fake move in the market, giving us a false signal. Either that or the bond market is dropping down for another major concern. And for now, we don't have any explanation for any major concern regarding economic growth beside Delta. We will have clarity very soon. But until then, the market will remain extremely choppy and extremely confusing. And with that, moving on to the conclusion of this video. What do we have on the economic calendar? Tomorrow, we have the per usual jobless claims. The economy created about 850,000 jobs last month, and we're seeing wage inflation climbing higher. We're seeing jobs openings climbing higher. So the expectations here that this number should drop below 350,000 claims. We also have consumer credit, but it is doubtful that this will move the market one way or the other because it is a lagging indicator. This is the number from May. So again, the expectations are no major events. We will continue to track what's going on with the bonds market and the options market because this is where the story is. The action in the bond market is hurting commodities and the inflationary trade. The action in the options market is helping big cap technology names, namely Apple. But this trade is also getting closer to an end. Anyhow, this is all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.